Buckle up, ladies and gentlemen. It's going to be a wild ride. I don't think anybody's really preparing for a monster rally into the end of the year, but we're going to be discussing the possibility for that in today's episode. Not to sound really overly bullish and or bearish on this channel, I'm going to give both sides of the story, and you can come to the conclusion yourself. You're watching the Stock Market Brief Show. My name is Michael. That right there is Coca-Cola. And then we got Jerome Powell over there with his little Santa hat, because we have the FOMC meeting coming up tomorrow, right? Yesterday's episode is starting to look like Christmas, but it sure doesn't feel like it. We got some stuff to talk about on today's episode. Let's get into the show. All right, everybody, welcome back to the show. I'm sure you've seen this chart before. I use it all the time. This is the S&P 500 post-election seasonality chart. And it gives us a good idea using a large data set of what to expect in seasonal times of what the market may or may not do. And seasonality, it's been playing out very well this year. Now, I want to point this out because a lot of people have been saying the Santa Claus rally, oh no, it's not here, all these narratives, everything's going on. But I want to just remind everybody, this pink line, that is an average year. The blue line represents more us, and what you can see here is we've actually seen selling on post-election years into the end of December, then you get that run up. So that's kind of like the first layer that I kind of want to put on here, because we are talking about potential rally into the year end. We're going to talk about more stuff, more charts here soon, but just notice where it stands towards the end of the year, a little bit more than midway, right? So, and we're here on the 14th, so we're not really even quite there yet. It's actually, a little bit towards the end, but just note, it's not always perfect. But based off of a 59-year range, you do typically get those end-of-year rallies, which other people call Santa Claus rallies. What happened today in the markets? Well, let's just look at a heat map of the Nasdaq 100. Microsoft down, Apple down, Google down, Facebook pretty much flat, and Amazon flat, Tesla slightly down there too as well. But there is some good news here, folks. Well, first off, just look how the market performed today intraday. It was pretty rough, all right? And Microsoft, it just goes to show you that a powerful move down in some of these big dog names, they can really drag the market. And that's why I've been kind of just talking about this more and more these previous weeks, is because they've been just strong moves throughout the entire year. Today we saw around, I think it was down intraday, around down 4% in Microsoft. And it really put a drag on other tech names and the overall indices. Now, this little guy up here, up at the top of the screen, that is actually an expected move for what the options market is pricing in. Now, it says plus or minus, right? So that means it can go up or down. That's, volatility, right? So it's basically saying here in the next couple of days, okay? So today's Tuesday. So between Wednesday's trading day, Thursday, and Friday, the market is pricing in the Nasdaq 100, the NDX, a $317 move. That's a pretty substantial move in a very short period of time. Now, if we look at the S&P 500, they're pricing in $72 move. Let's just call it $73 move. So once we get to the charts, we'll talk about that here. But $73 in just a few days, what does that mean? Well, it means that if we meet either the upper edge or the lower portion of that move, we're going to see that Santa Claus rally, or we're going to be pulling back further, obviously, in the S&P 500. And we'll map out some key levels to pay attention to. Remember, I think it was the Theo Trade team said around, I think their math was 68% of the time, if I remember correctly, 65 to 70% of the time, I can't remember. The expected move, the price of the S&P 500 will land within that range, okay? So typically if it meets up to the upper range, you might see it hit, and then it'll doodle around there like we saw last week, or if it hits the bottom, it might doodle around, and we see it actually hit the lower edge earlier today, I think it was. All right, so let's continue on, or yesterday. Microsoft. All right, so Microsoft down 3.26%. So it was down more substantial actually throughout the day, a little bit more than 4% actually. But what I want to call out here is the options market is pricing into the coming into the 17th, almost $10 move, and we closed right here at about 330, just under it. So basically just under 340 and just above 320, or just under 320. Sorry. This kind of range in here is what the options market is pricing in for Microsoft coming in to just a few days of trading. Now, what I want to point out is this. The overall price action, okay, the market right now, you can see the trend is clearly up. You have all the moving averages, the river's flowing up. They have a nice spread between them all. And you can see that the 50-day and the lower Bollinger Band was hit, and it acted as support. Okay, and you can see that there was clearly demand in that zone as buyers pressed it right back up. And that lined up actually with this gap fill right over here too as well. Okay, so from a price action perspective, ignoring just even the expected move, if bulls want to start progressing forward, I can definitely see them running this back up to fill this gap that was just left open, which would go to the upper edge of that expected move. Now, we've seen what Microsoft does when it tanks. Okay, it brought the market down. When it tanks, it brought the market down, the S&P 500, the Nasdaq 100 down with it, because it's a large cap, mega cap stock. So if we see this thing rip right back up to the upside, chances are that's going to really help the overall markets and individual tech stocks too as well. But just be mindful that this is, once again, pricing in volatility. It's undirectional bias. So I'm just trying to show you from a price action perspective what to potentially expect. So if we do start cracking down through this low and get below that 50-day moving average, yeah, be careful, okay? That obviously, well, maybe it doesn't go without saying. But now, let's keep on moving. Google pricing in about a $70 move. And now another thing why I'm saying prepare for a potential rally. Now, I know we're coming into an FOMC meeting. That's why we're seeing this expansion, these larger ranges of volatility. We're creating a lot of uncertainty, all right? So people, it's not something that you want to really rush into. That's not what I'm saying. So from a price action perspective, we've seen candles like this before, right here. Where did we land? Right there, the same place. 100-day moving average, it's sloping up. Price action drive right back to that 50-day moving average. This is a long-legged doji right there, okay, or a hammer candle, whatever you want to call it. But it shows that there was clearly a lot of demand right here. So overall, yes, it's trading within this range. It's likely if we get that $70 move, why couldn't we pop right back up to fill this gap and even then some? Okay, so that is also the case that if we get Microsoft and Google to rally into this week, we might see very strong moves in the overall markets. Now, like I said, this could drop minus 70, okay? And that means we'd be getting below that 100-day moving average, which could obviously present itself, some more fear in the markets. Let's keep going. Tesla, another big weight over here, okay? This is pricing in about a $45 move into the 17th. But why am I calling this out? Well, one, we did close below the 50-day moving average. That's not the greatest thing. But what I want to call out is this red to green candle. So we gapped down, came down a little bit lower, almost filled the gap that we've been talking about, right? Made it smaller. And then we started getting some demand and pushing it back up. I can see this still potentially closing this gap and seeing some traders hanging out. But because it's so obvious, because that gap is so obvious, you might have premature traders over here jumping in and running the price up, which is more than possible, right? Because some people might be like, well, I might not get filled right down there, so I'm just going to go ahead and get in a little bit earlier. More than possible. But just keep in mind, it's pricing in a $45 move, so it could make a little bit of a run, right? It could go retest that 50-day moving average, which can obviously help out the various other indices and other stocks kind of within this category. If it falls down, obviously, because remember, we can go minus 45 or 46, whatever it is, that would definitely fill the gap right beneath us, actually, right, just kind of right in that zone, okay? So keep that in mind as well. All right, let's go to the next one, Nvidia. Nvidia took a masterful hit to the downside right there, but pay attention. It's pricing in, $15 move going into Friday, okay? So it's obviously a large range of volatility taking place. And where did it land? Price came right to the 50-day moving average as buyers' demand was right there, and it pushed the price right back up to that lower Bollinger Band. So not only did it tag the confluence of support of the 50-day, but it also is right there at the lower Bollinger Band too as well. So seeing a bounce up to hit the upper edge of a $15 move is more than possible. Perhaps even coming up to around through 295 to 300. I could see that as a strong possibility, but just keep in mind. All right, it's been kind of rolling itself over, and we have this little gap right here still. Okay, it almost tried to come and fill it today, but it didn't quite reach it. As I said previously on Tesla, maybe people jumped the gun and bought in. It's really you're gonna see a lot of volatility right out of this FOMC meeting, what's gonna be said. But from a price action perspective, you can see that some of these stocks are coming into areas of support and showing some demand. So it's a time to be careful. It's a time to be cautious, but just also note that this expansive range in volatility could very well signal and match up with seasonality that we could be seeing some sort of a bounce here very soon, as the overall market has been getting a little bit overextended. Let's carry on into the market health dashboard. We're going to take a look at a couple of indicators here. We're just looking at the Comp Q, the Nasdaq Composite, and you can see down over here, we gap down, create a little bit of a hammer candle as we tagged into that lower Bollinger Band. We still haven't taken out this lower range, so be mindful of that. If we start taking that out, yeah, obviously be a little bit more scared. One thing to point out is lower lows. What am I trying? New lows, sorry, have been consistently building up, and our new highs have been dragging, which is not obviously a great indicator. We're going to talk about the Nymot here in a moment. And then the advanced decline line has been still just getting destroyed. So overall, breadth is not doing good. Actually, I'm pretty sure the Hindenburg Omen indicator has triggered once again, which is obviously just showing us that there's a deterioration of breadth in the markets. Let's continue to the the New York Stock Exchange primary index, which gives us a more broad view of the overall market. New highs declining, new lows inclining, not good. Breadth decelerating still, and you can see the relative strength line continues to just kind of flat to and then you see the advanced decline line still tagging that 50 and still heading lower there too as well. So overall, it's not looking too hot. However, couple of things to point out. We're looking at the Nymot now, which we just said we discussed in the Nymot. So the Nymot is getting a minus 40 reading, and I've seen this to be a kind of an extended area before too. A little bit lower, right? Minus 80. That is where it gets very overextended, where we've seen obviously a bounce just recently. But I've seen cases where it reaches down to this 40 to 50 range, and that also marks a temporary bottom where you potentially see a bounce. Okay, so I just wanted to call out it's getting a little frothy, little overextended to the downside. If we go ahead and take a look at the Nymot, which is the Nasdaq Mcclellan Oscillator, this one's also getting pretty heated to the downside. Minus 60 and a little bit lower is obviously overextended. We got overextended minus 80 right there, and that marked that bottom right there. You know, right here was another one, marked that bottom. Right here, got a very extended reading, we marked that bottom. But we're getting back there again, so just be mindful that this is getting back to overextended territory, and that could represent that we might potentially get a bounce here shortly too as well. Another way to think about this also is the market's been seeing a lot of volatility. It's been heading down. This could be the market basically pricing in the Fed announcement already, where the market's pricing in that they are going to speed up taper, maybe move forward rate hikes. We'll see if there's potentially a change in any of that, but they're pricing it in. So this could be basically when the announcement actually comes, we might actually see the rally, right? Because prices have already kind of priced in the potential worst case scenario. Now, like I said, we don't know yet because the volatility, right? It's not directional bias, it's plus or minus, but that's why I'm showing you both kind of bear cases and bull cases here and lining up some price action levels. Now, one thing to watch is the Trin Indicator. I like to use it on the hourly time frame. It's smoothed over a 10-period moving average. And when it gets above this green line, that's typically a good buying time. But when it gets below the red line, that's not the greatest time. And we've seen some sell-offs take place. But just pay attention. It hasn't got to overextended for over basically 2 months now in either direction. So, I just wanted to call out it's pointing down, and potentially if it reaches down to the red, that can be a little bit of a warning signal. It is pointing that way, but that does not mean it's going to make it. Another thing to pay attention to is consumer staples over SPY. We've been watching this indicator as I've been pointing out this positive divergence for quite some time on the relative strength line, and then also the rate of change got back above that zero line as we're seeing consumer staples start to outperform the S&P 500, which is a little bit more defensive, obviously, and we've seen this happen back in the day over here in 2000 to 2008. Obviously, we saw that big run up. That was during the financial crisis. This is relative strength, so that basically means that they can both go down. It just means that consumer staples, if this line goes up, means consumer staples is outperforming the S&P 500. Okay, it doesn't mean that they can't both go down. It just means this one would be going down less if that was the case. Okay, but I wanted to call that out. Consumer staples is still continuing to gain some strength, which is a little bit more defensive posturing right now. Another thing that's not the greatest look is the New York Stock Exchange Mcclellan Summation Index, still below zero, still heading south at this particular point in time. And really, I mean, when we get these crosses below zero, you might see temporary bounces, but nothing ever really good happens when it gets below the zero line. Now, another thing to match it up with is the Nymot. And this, I wanted to indicate that when it shows both below zero here and a minus 300 rating there, we've seen some turbulence in the market, as you can see these three blue diagonal lines. This right here, it actually got a 295 reading. It didn't quite get to that minus 300. All right. So we did see that little bounce up, but you know, it's pointing right back down. It's still below zero here. We'll continue to watch that. You know, we gotta be careful. Let's look at the S&P 500 of the 11 sectors that make up the S&P 500 here. We're looking at the very top, consumer staples, financials, materials. Financials obviously up the most, actually one of the only ones that were up. Consumer staples was slightly up, so a little bit defensive posturing. Interesting to see overall. Yields took a little bit of a break today. At least I believe that they did. I think I brought my yields. Nope, I don't have them up. I know that I saw the spread, the 10 and 7 relatively flat for the day. And then also I think the 30 and 5 slightly went down. I have to double check, but that's okay. Let's look at this. The indices right here, Dow Jones, S&P 500, Nasdaq. Nasdaq was the one that was down the most on the day. And you know that when technology is the laggard, right, and the Nasdaq is going to have the worst day, it's going to bring down these other indexes too. It's just very hard for them to perform well, especially the cap-weighted, you know, the S&P 500. But it held up fairly well, and it held up fairly well because, well, financials is obviously a big sector too. But what I want to call out here that's pretty neat is materials. So materials was rather flat on the day, and I'll show you here on an absolute basis. But what I want to point out is if you take a look at the intraday performance of materials, you see aluminum and steel that did very well. So some various steel stocks that kind of looked like they might be getting ready to pop a little bit was X. That's a steel stock. And then also for aluminum, I pulled up, well, actually, let me just bring it up right now. So these are some of the stocks that are within aluminum, and AA was up 5.61%. So that looked pretty darn good. And I brought up a price chart of it too as well, because I wanted to just take a quick gander. But the price had a nice volume surge right here, and it's been kind of forming this base. So potentially this might be a good play. Actually, if it starts cracking through these previous levels right here, might get us up, might set us up to retest that previous all-time high. So that might be one to potentially watch. But what I want to call out too, if we look at the 11 sectors from an absolute basis, materials is just kind of trotting sideways here as it still remains above the 20-day. So this is actually pretty good as it came up, but just notice there's still supply trapped up over here on the previous side. So keep an eye out if it starts breaking above this 89 range, slightly below that, that could be very bullish. But if it starts breaking below, right, the last trading day, it's not that great. It's like a little bit of a hammer candle. So if it starts cracking down through this box, just be mindful that we might go retest that 50-day moving average, and it might put a little bit of a pause to some material stocks. Not really much else to call out across the board over here. Communication still is that big laggard, and we still have defensive names leading the way, real estate, utilities, XLV and XLP. By leading the way, I mean from a relative strength index, RSI perspective. We're going from a descending perspective, so it goes down like so. Actually, no, yeah, like so. Oh, whatever, doesn't matter. Let's look at the dollar. Swing to the dollar. All right, here. So the dollar also caught a little bit of a bid today. It started off lower, but it caught a bid to be relatively flat for the day. Still, obviously, tightening up, consolidation, break of this is imminent. It will take place. Notice the Bollinger Bands. Remember, expansion leads to contraction. Contraction leads to expansion. And we see the Bollinger Bands tightening up as price action continues to tighten up here too. It's looking like it's about to start making a move here rather soon. And I'm assuming that it's going to probably make a dramatic move coming into the FOMC meeting. That to me would make the most sense. Let's take a look at commodities, then we're going to get into the indices. Gold down on the day as the dollar, found some strength. Could be potentially bear flagging if this starts breaking down. Well, okay. Be mindful of that. But overall, still within the trading range. Not much to report on gold at the moment. Silver was down 1.81% on the day. Still holding up at this level of support. But man, it got to do something, and it got to do something quick, or it's going to start breaking down from these levels rather fast. All right, let's continue on. Oil also has not done much for a few trading days, just going sideways. This looks like a dead cat bounce, but you know, we'll see what takes place here. You can see this little candle right here, not quite a doji, not quite a high wave candle. I would just say that's maybe a spinning top type candle, but you can just see basically the bulls and bears. The bulls fought up, the bears fought back. So it basically shows that there's a struggle of between the bulls and the bears, like who's going to win out right here. So I'm just thinking that if we start cracking above 73, the bulls are going to take over the bears' little camp right here. And if we get cracked beneath the low of that candle, which was where were we? Low, yeah, 71. I'd say just 71. No, sorry, 69.50. If we get a crack below 69.50, that means the bears kind of took over the bulls camp, and we might head a little bit lower. All right, and that could put pressure on various energy stocks too as well. Let's take a look at copper. Copper down on the day, and this trend line looks important to watch. Still holding up so far, but you can see we are stair-stepping ourselves down. So until that changes, be on the lookout for coppers breaking down. Bitcoin, I saw a little bit of a bid back up today, but we'll see how this kind of plays out. Right now, I know from a price action perspective, we might be able to call this a falling wedge, and we've seen that prior. The only thing to watch out for is this trend, obviously, that was broken. So if we do start getting a bounce, just be mindful that it could come up to retest something, and that might bring in, yay, we're all good, but we're not really in the clear yet until we reclaim that 60,000 level up here, which would reclaim the 20, reclaim the 50 too as well. So we're not out of the woods, but it's at least basing out. It's forming right here. It could be flagging, right, where we have another leg lower. So that's always a possibility too. So just be very mindful, be very careful in this current environment. If we take a look at Ethereum, the trend line here is still holding up. We'll see if it continues to hold up. If it breaks, I still think that we can come to the 200-day moving average, which is around 3,200 on the price of Ethereum. On a good note, guess what? We got the Bitcoin, the Sailor to Shift ratio starting to turn itself back up. Now, remember, we've seen it turn up before to turn right back down, but we've also seen it turn up to turn up, and then we got a buy signal, and then we got that rip and rally. So, it's a good development to see this start turning up. Just keep in mind, nothing's certain in this environment. So don't jump the gun. I mean, you could jump the gun early from a price action perspective. If we start getting above 52,500, that would make sense because it also lines up with this resistance. And if that's resistance, and once resistance is broken, it then becomes a level of support. So then we might be able to start heading higher there. But yes, just from a good overall perspective, we're starting to see it curl up. So hopefully here we can start seeing some positive movement there in the crypto space. Let's take a look at the indices. We'll try to move through these very quickly. S&P 500. Remember, the price is pricing in a $72 move in the S&P 500. So we closed at 56.34. Okay, so let's just say 4,700 to the upside. If that's the case, right, in just a couple of days' time, we'll be right back up to the previous all-time highs if we hit that upper edge. But, there's always the possibility that we break down and we come right back down to around that 50-day moving average, okay? Still, keep in mind, right, we have some supply or some demand that stepped here. Guess what? We filled the gap that was right beneath us almost all the way, right? We closed right there, so slightly off, but we did close it from, if you're just looking at the upper wick, and we found support right there and it started bidding right back up. We're overall in an uptrend, right? The 50 days up, 100 days up, 200 days up, so the trend hasn't been broken, right? We have a high, lower high, we have a low, and we still have a higher low right here as of right now. So until we take out, I would say more of this range, the 4,500, I'd be a lot more cautious. But overall, looks like a little tiny hammer candle. Price did get below the 20-day moving average, so it still has some work to do. But like I said, volatility can go both ways. It can go down, but it can also go up. And by looking at some of these charts that have moved down into areas of support, the ones that are important, maybe we might have a chance here to get a little bit of a run up again. Let's look at the SPY on the 15-minute time frame. We closed below that 5-day moving average. That bear flag did play out as price action broke out of that channel, came in, almost filled that gap fully, like I said, and then we found some support there. Maybe traders jumped the gun because they didn't know if it was going to fill all the way, so they wanted to fill early. And then we got that run up right there towards the end of day. Let's continue on to the Nasdaq 100. I wish I kind of zoomed in a little bit more. This was pricing about a $300 move, a little bit more than that. And, you know, we came down, filled the gap, right? We broke out of this. We were talking about that, said if we start cracking down through this, which we did, we probably come fill the gap. And guess where we landed? Well, we landed exactly where we talked about yesterday, right around that 50-day moving average, right around that lower Bollinger Band, right around that gap fill, formed a nice little hammer candle right here. So, yeah, hey, perhaps we, like we said, get a bounce. Just be cautious, right? There's going to be a lot of shaking and a lot of moving around as soon as that announcement comes out. Let's go ahead and take a look at the 15-minute time frame, get a little bit better picture here. 15-minute time frame, we gap down. I don't know if anybody's been saying this, but these are sometimes known as island reversal patterns. So, you know, we gap up and then we gap down through it, and we just leave some candles up ahead, island reversal, where we could potentially very well head lower. We did fill the gap, but we did head a little bit lower. Now, what I was saying was look for the gap fill and play an intraday bounce. Well, right out of the gate, if you were quick enough, this very first candle opened up, headed down very slightly, and this just ripped up for an intraday move, and then that got faded fairly quickly, and then we started moving back up towards the end of day, creating that hammer candle that we discussed on the daily time frame. Let's go ahead and move on to the IWM. The IWM still within a trading range, nasty looking candle for the day, but also from a positive note, look at we gapped down and then the bulls showed up. The bulls did show strength today, right? We did see some demand, but the bears forced that price back down, creating this candle, this inverted hammer candle like so. Now, keep in mind, these are actually sometimes reversal candles also in moves to the downside. Why would that be a reversal candle? It's pretty bearish. Well, yeah, it is. It's a bearish looking candle, but it just really depends on where it's priced. Right now, from a move to the downside, it's showing us that bulls have stepped up here before. And you can see bulls have stepped up here previously right here. Previously right here. And they showed it right back up again too as well. But remember, there's still a lot of force moving down to the downside, obviously, as that created that long upper shadow. So yeah, if we start cracking down through this 212, 210 kind of zone in there, yeah, just be mindful, be careful, because we could obviously break lower, but we're still in a very long-term channel. If we take a look at the 15-minute time frame, we broke down. We headed to that 213, 212 range that we discussed. That positive divergence showed up. We saw that bid back, but then it sold off towards the end of the day. Still below that 5-day moving average. Has a lot of work to do here, so just be careful with the IWM overall. Nope, that's all I got for you actually on today's episode, everybody. Hope that helps out. We mapped out some key levels. Obviously, the market is pricing in some big swings, big movements of volatility. The big thing to get away from all of this is paying attention to the price action of these big names as they formed some very bullish type candles at some areas of support. So it does look to me like, hey, you know, depending on how this FOMC meeting goes, we might be able to see a little bounce. But remember, volatility, once again, it can go both ways. All right, so be very careful in this environment. Hope that helps. See you later.